Hello, everyone, and welcome to our virtual event on Canadian benchmark reform. I'd like to take the opportunity to thank Bank of Canada for supporting and helping organize this session. At ISDA, we're committed to raising awareness of benchmark transition globally, and events like this are a critical part of that effort. A little over a month ago, we experienced one of the biggest upheavals ever to occur in financial markets: the termination of 24 LIBOR settings and the permanent non-representative of 6 others. It's difficult to underplay just how big a change this was. LIBOR was prevalent in virtually every sector of the financial markets, amounting to hundreds of trillions of dollars worth of contracts. The fact that we were able to navigate through the cessation event without serious market disruption is testament to the strong determination of regulators, central banks, and financial institutions to tackle this issue. And it was also due to an unprecedented level of cooperation and coordination between the public and private sectors. Regulators and market participants confronted the challenge in a variety of ways, but a big part of the solution for the derivatives market was ISDA's work to develop robust contractual fallbacks. This ensured viable alternatives based on risk-free rates that automatically kicked in for most non-cleared derivatives that continued to reference those 30 LIBOR settings after December 31st. This was a massive reduction for the potential for systemic risk. The fallbacks also formed the basis for central counterparties to transition cleared LIBOR derivatives directly to risk-free rates late last year. Those fallbacks just don't apply to LIBOR, however. They also cover a variety of other IBORs, including Cedor. With discussions on the future of Cedor now underway and a potential target date for cessation due on June 30th of 2024, it's important that everyone active in the Canadian markets understand how the fallbacks work and how they might impact outstanding Cedor trades. Now, I'd like to start my remarks by outlining the mechanics of the fallbacks. I'll then describe what would need to happen in order to trigger those fallbacks for Cedor derivative contracts. So starting with the fallbacks themselves, the ISDA 2020 IBOR fallback supplement and protocol came into effect just over a year ago on January 25th, 2021. From that date on, all new derivatives that referenced ISDA's standard definitions, including the fallbacks for certain key IBORs, including Cedor as a matter of course. By adhering to the protocol, firms can also incorporate the fallbacks into their legacy non-cleared derivatives with other adhering parties. The fallbacks are based on risk-free rates, but with an adjustment to reflect a portion of the structural difference between the IBOR and the RFRs. For derivatives linked to Cedor, the fallback is based on the Canadian overnight repo rate average, or CORA. Following multiple industry consultations, it was determined that the fallback for each IBOR setting would be based on the relevant RFR compounded in arrears with a shift, plus a spread adjustment calculated using the historical median of the differences between IBOR and the fallback rate over a 5-year look-back period. It's important to note that ISDA worked very closely with the Canadian Alternative Reference Rate Working Group during the consultation process, as well as other national working groups. Now, this won't be new to many of you who have experience with the LIBOR transition, so I'll quickly turn to how fallbacks would work in the event of Cedor. As I'm sure you all know, on December 16th, the Canadian Alternative Reference Rate Working Group published a paper recommending that Refinitiv Benchmark Services Limited cease publication of all Cedor remaining tenors after the end of June 2024, although it emphasized the decision ultimately lies with the RBSL as the administrator of Cedor. Earlier this week, RBSL followed up with a consultation on the future of Cedor with a deadline for comments on February 28th. Now, it's important to point out that neither the recommendation by CAR or the consultation by RBSL represents a decision that Cedor will actually cease. As a result, neither meet the criteria for an index cessation event under the ISDA supplement or protocol, meaning the fallbacks have not yet been triggered for derivatives linked to Cedor, and the spread adjustment for fallbacks has not been set. That will only occur if and when RBSL announces that Cedor has ceased or will cease in the future. Such an announcement would immediately trigger a fixing of the spread adjustment portion of the fallback rate, irrespective of the actual date of cessation and when the fallbacks will kick in. This fixing spread will be published by Bloomberg, giving firms full transparency on the exact fallback rate that will apply. Now, fallbacks play a critical role as a safety net ensuring trades referencing an IBOR, such as Cedor, continue to function without disruption if and when cessation occurs. We strongly believe that the introduction of fallbacks played a key role in smoothing the shift from 30 LIBOR settings over year end. So far, more than 15,000 entities across the globe have adhered to the ISDA protocol, covering a large proportion of outstanding non-cleared derivatives trades linked to LIBOR, Cedor, and certain other IBORs. If you have not yet adhered, there is still time, and we very much encourage you to do so. Now it's time for me to introduce our keynote speaker, Toni Gravelle. Toni is the Deputy Governor of the Bank of Canada, a role he assumed in October 2019. Before that, he was Managing Director of the Financial Markets Department, having initially joined the bank back in 1996. Toni, we're really honored to have you join us today. The floor is yours.
Good morning. Thanks, Scott, for that kind introduction, and thanks to ISDA for hosting this important event. I would like to begin by acknowledging that the land on which I am speaking from is the traditional unceded territory of the Algonquin Anishinaabe people. I'm glad to be here alongside these exceptional panelists to talk about some important changes that may be coming to Canada's interest rate benchmark. En fait, une réforme des taux référence est en cours à l'échelle mondiale. Depuis 2013, l'Official Sector Steering Group du Conseil de stabilité financière oriente les efforts pour établir des fondamentaux plus solides pour les produits financiers partout dans le monde. La Banque du Canada est membre de ce groupe d'orientation. Une des grandes fonctions de la banque consiste à favoriser la stabilité et l'efficience du système financier. On doit donc soutenir les efforts pour rendre l'architecture du système financier canadien robuste et résilient. And of course, the bank is a central player in the Canadian Alternative Reference Rate, or CAR, working group on benchmark reform. This group was established in March 2018 and includes many key stakeholders from Canada's financial system. In 2020, CAR was tasked to take a closer look at the Canadian dollar offered rate, or Cedor, which is currently the predominant interest rate benchmark in Canada. The group explored how to bolster the robustness and resiliency of Canada's benchmark regime. This involved analyzing Cedor's efficacy and making recommendations for the future based on that assessment. By way of background, Cedor has been around for about 40 years now. It was originally conceived as the basis for pricing lending facilities related to bankers' acceptances, BAs. It's a forward-looking term rate that incorporates bank credit, and it has served us well since its inception in the 1980s. Aujourd'hui, administré par Refinitiv Benchmark Services, le Cedor est utilisé pour des opérations totalisant plus de 20 000 milliards de dollars, ce qu'on appelle l'exhibition nationale brute. Les produits dérivés représentent 90% de cette exposition, même si une partie de celle-ci est aussi liée à des obligations et des prêts à taux variables. Comme je l'ai dit, le Cedor nous a bien servi. But in the first part of CAR's review process, analyzing Cedor's efficacy, it became clear that some aspects of its architecture could pose risk to its future robustness and resiliency. One involves the new, higher standards that are expected of critical interest rate benchmarks around the world. These standards, developed by the International Organization of Securities Commissions, or IOSCO, provide the goalposts for robust benchmarks. IOSCO's recommendations that benchmarks be based on large volumes of underlying arm's length transactions. This concept is enshrined in the benchmark rules recently introduced by the Canadian Securities Administrators. But Cedor is set based primarily on expert judgment rather than on transactions. Another risk is that banks are starting to move away from the BA lending model, which was the basis for the development of Cedor. We are seeing more loans that reference Cedor but do not result in traded BAs. When this happens, the BAs that are issued are increasingly being held on balance sheets instead of being sold into the market. The shrinking supply of issued BAs erodes the foundation upon which Cedor is built. With these issues in mind, CAR considered whether it would be possible to reform or enhance Cedor. It was determined that this wasn't a tenable option, largely because Cedor, by definition, could not be tied directly to arm's length securities transactions without changing it into a new rate. In the end, CAR recommended that Refinitiv stop calculating and publishing Cedor after June 30th, 2024, as Scott mentioned. I should note that this is just a recommendation, something that Refinitiv will have to consider and decide upon independently. CAR also recommended a two-step approach to transitioning away from Cedor. The first stage would run until June 30th, 2023. During this time, almost all new derivatives and securities contracts would migrate away from Cedor and towards CORRA, the Canadian Overnight Repo Rate Average. CORRA is the other major Canadian interest rate benchmark. It measures the overnight cost of funding general collateral in Canadian dollars, and it uses Government of Canada Treasury bills and bonds as collateral in repurchase transactions. As a result, it's considered an overnight risk-free rate in line with international best practices. The bank took over the administration of CORRA in June 2020. Comme je viens de le dire en anglais, le CORRA est l'autre grand taux d'intérêt de référence canadien. Il mesure le coût de financement à un jour en dollars canadiens sur le marché général des pensions. Et il utilise des bons de trésor et les obligations du gouvernement du Canada comme garantie pour des séparations de pensions. Il est donc considéré comme un taux sans risque à un jour, conformément aux pratiques exemplaires internationales. La banque administre le CORRA depuis juin 2020. For the second phase, between June 2023 and Cedor's potential cessation date in June 2024, loans would move away from Cedor. This phase would give firms more time to transition their loan agreements and deal with potential issues related to redocumentation of legacy securities. I want to stress that these recommendations have been unanimously endorsed by CAR members, as well as members of Canadian Fixed Income Forum, so they reflect the views of a broad range of Cedor stakeholders. But ultimately, the decision to see Cedor lies solely with Refinitiv, and I'll come back to that in a minute. For now, let's take a quick look at what may change if Refinitiv phases out Cedor. As I indicated earlier, the impacts would be largely in the derivatives market. Fortunately, in late 2020, ISDA strengthened the rules that would apply to derivatives if a relevant benchmark was discontinued, and Scott went through a lot of that in his opening remarks. As we have seen in other jurisdictions that are transitioning between financial benchmarks, the lending market would be more complex in terms of transition. Phasing out Cedor would certainly have operational implications for financial institutions and corporations that currently use it when borrowing. We don't have all the answers yet in terms of what the financial system might look like after June 2024. For instance, what would happen to BA lending model that is the foundation of Cedor? Moving away from Cedor would certainly require effort from all participants in the financial system. So it will be important to hear from those that may be affected by the cessation of Cedor. To this end, Refinitiv recently launched a consultative process to better understand possible ramifications. I encourage all of you to take part in this. It's an important way to ensure we are moving forward with benchmark reform in Canada that reflects Canadian realities. And of course, we can watch and learn from benchmark reform happening elsewhere, like with LIBOR. I'm going to conclude my remarks here so that we can spend more time discussing the specifics of CAR's recommendations and what they mean for the future. I look forward to the inputs from Barbara, Axel, Carl, Tom, and the thoughts and contributions from everyone in attendance today. Thank you very much.
Toni, thanks very much for those insights. We're now going to turn to our panel discussion, which will explore the future for Cedor. The moderator for this session is Sonia Baxendale, President and Chief Executive Officer of Global Risk Institute. Sonia, over to you.
Thank you very much, Anne, and welcome everyone. Thank you to Scott and Toni for kicking off the discussion today with your remarks. I think you've perfectly set us up for the panelists today with this background and highlighting some of the implications and the plans to prepare for these developments. As Anne mentioned, I'm going to be your moderator today, so let me start by introducing your panelists. Toni will be participating on the panel. We'll also have Barbara Hooper. Barbara is Senior Executive Vice President, Treasury, Corporate Development, Strategic Sourcing and Real Estate of the TD Bank Group. Carl Wildey, Managing Director and Vice Chair, Global Markets, CIBC World Markets. Tom With, ISDA board member, vice chairman of institutional securities, Morgan Stanley, and chair of the Alternative Reference Rates Committee, and Axel van Nederveen, ISDA vice chairman, managing director, treasurer, European Bank for Reconstruction and Development. I'd also like to introduce and acknowledge Harry Vikstead. Harry is Senior Policy Director, Financial Markets Department, Bank of Canada, and co-chair of the CAR Working Group. All of these individuals have been very actively working on behalf of not just their organizations, but the industry at large through the various working groups. So welcome to all our panelists. We've organized today's discussion into really three distinct groups. One, some background on Cedor and Cora. We'll spend the least amount of time here because Toni and Scott have really set us up for this discussion, but I do want to make sure that we have a bit of a level set, so we'll spend a few minutes on this. We'll then spend the bulk of our time on term rates and BAs, and then finally on transition issues, and our panelists will weigh in on each of these items. We will take participant questions in each of these sessions, so please type any of your questions into the chat as we go along, and we'll try to get to them as we're covering the subject matter. We will also leave time at the end of the discussion with the panelists for a detailed Q&A on any aspect of the benchmark reform. So with that, I'm required to take you through the disclaimers before we get started. So I would like to note that the views expressed in this panel discussion are the views and opinions of the panel members and do not necessarily represent the views of their firms, institutions, or working groups that they participate in. Of course, the future path of Cedor depends on whether Refinitiv follows CAR's recommendations. While we have no view on the likelihood of this, to facilitate our discussion today, we will work under the assumption that Refinitiv will fully agree with CAR's analysis and recommendations. And just a final reminder, please, this session is for all of you, our participants, so please, I encourage you to put your questions into the chat. So with that, let's get started. And I would like to spend a few minutes on the background, and I'm going to start with Carl. Carl, Toni mentioned that CAR had uncovered some aspects of Cedor's architecture that pose risks to future robustness and resiliency. And I wonder if you could go into a little bit more detail and highlight some of those issues for us.
Thanks, Sonia. I'd be pleased to. And maybe what I'll say is, if we go back a little bit, when we started out this journey of benchmark reform here in Canada, that really the basis of our starting point was that Canada was going to be a multi-rate jurisdiction. And so most of our work following the inception of CAR in March of 2018 was focused on risk-free rates. And so we, our first task was to determine the scale and scope. Then we looked at Cora, we reformed it, the Bank of Canada published it, as Toni said, and we concentrated our efforts on putting the seatbelts and airbags in place through conventions and fallbacks. When it became apparent, as Toni eloquently said in his speech, that the bar was going up for benchmarks, whether it was related to IOSCO principles or it was related to the benchmark regulation, it really was incumbent upon us to have a good look at Cedor. Cedor is different than LIBOR. Its volumes had actually increased post-financial crisis, and it was a lending rate, not a borrowing rate. So it was different than LIBOR. But that, notwithstanding, was why we brought the review, analysis, and ultimately recommendations related to Cedor into CAR's mandate in October of 2020. So that was the past year has been very focused on Cedor. And the frailties or considerations that were raised were really fourfold, and Toni touched on two of them. The IOSCO principle that benchmarks be rooted in transactions was essentially and definitionally difficult for Cedor. Cedor, by its definition, is the rate at which panel member banks offer out their balance sheet under BA facilities. These are corporate lending facilities that banks offer to largely Canadian corporates. This rate does not lend itself to a third-party transaction. And so as other benchmarks reform themselves, creating waterfalls, this was not available to us in Canada and created what was a risk to its future robustness in respect of relying exclusively on expert judgment, which in the waterfall methodology tends to be towards the bottom. The second area which Toni touched on was the interconnectivity between Cedor and BAs. So Cedor was developed as a reference rate for these BA facilities. What was interesting and this has been an evolving methodological change within banks, that even though a funding liability was created, that we didn't match fund it in the market. So the BA construct suggested that when a corporate borrows from a bank in a 1 month tenor, that it creates a BA security that we would then put into the market for 1 month. That concept was no longer consistent with best practices, especially post GFC and the imposition of LCR and NSFR. Banks term fund these committed facilities. So the whole concept on which this BA construct was established was no longer foundational, and we were seeing, as Toni said, banks starting to migrate away from them, either by holding BAs on balance sheet or by moving to other non-BA related lending agreements. The third thing is related to IOSCO principle of proportionality, or as they also refer to it as the inverted pyramid, that there should be some proportionality between the risk that relies on a benchmark and the transactions that support it. And in Canada, Toni referenced that there are $20 trillion of exposure, most of that being derivatives, and most of that exposure is based on 3-month Cedor. In terms of transactions in the BA market, which provide a key determinant into the setting of Cedor, that 85 to 90% of those are 1 month. So there is a disconnect between the 3-month and 1 month tenor in terms of the robustness underlying ultimately the lion's share of the exposure. The last issue was one that was prevalent for LIBOR and led to ultimately to Andrew Bailey's speech in 2017, is around the panel sustainability. And so in Canada, on the Cedor panel, there are 6 panel member banks. That's down from 9. And ultimately, as regulation has come in and raised the burden on panel members, there was a risk, not dissimilar to LIBOR, that you could get some panel members signaling that they no longer wish to be on this voluntary panel. So that also created a future frailty for robust and resilient benchmarks. And really what we were focused on here was, how do we create a benchmark regime that the investment community can rely on, not just currently, but for the next generation and the generation after that. And it was on the basis of those that we made our recommendation in December to cease the publication of LIBOR or of Cedor.
Thanks, Carl. That was really helpful. I think the distinction with LIBOR is very important for everyone to be quite clear on, and you commented on the BAs, which is a key transition point, and we'll get to that in a bit more detail. Let me turn to Toni now. Toni, you mentioned that in your opening remarks that most of the current exposure to Cedor will be expected to transition to CORA and that the bank has taken over the administration or took over the administration of Cora in June of 2020. Can you maybe make some comment on what the bank has done to enhance the calculation of Cora, and also why the bank took over the administration and the sort of the implications and benefits of that?
Sure. CAR did a lot of work to look at enhancing Cora. Cora has been in existence for quite some time. It's always been meant to be a measure of what overnight collateralized funding in the Canadian market, a benchmark measure. It used to be based on transactions largely coming from the interdealer space. So the main innovation or the main enhancement to Cora is to broaden the transaction base for where to calculate Cora and get a broader sense of the overnight funding rate, collateralized funding rate in the Canadian economy. So that was one of the main changes to Cora in terms of its enhancement. So now Cora moved from being based on interbank transaction to the whole of the market in terms of overnight GC funding. And it's based on approximately 15 to 20 billion worth of volume. That's a 10-fold increase in the volume relative to what it was based on in terms of interdealer transaction. The other enhancement was an adjustment to the way it's calculated. It was important for the calculation to consider, now that it's including all transactions, to consider or at least adjust for specials. So there's an adjustment to the calculation just for that. CAR had consulted on that and provided those recommendations, and that's where we ended up with in terms of the enhanced Cora, which is now known as Cora only. So the rate is now available for free on our website. We're the administrator. We took over the administration, as I said, in 2020. We took it over as a public good. There's a lot of work that goes in keeping that fresh and clean. And it's also because we had already access to the underlying data, which is based on IROC's market trade reporting system to calculate the rate. Just to highlight that there's also a core advisor group that provides advice in terms of any adjustments related to the core calculation or any other adjustment that might be needed. It is an industry group that provides advice to the bank in terms of our administrative duties. It's basically made out of subject matter experts related to the overnight rate. And then finally, there's an undertaking to review the methodology every 5 years to make sure it remains appropriate.
Terrific. Thank you, Tony. I'm going to keep us moving, and then we do have some questions coming in, and I'll come back to those questions in a few minutes, because I want to move on to the implications of the transition on BAs and term in particular. There have been a lot of discussion on the potential need, in addition to the overnight rate, for a forward-looking or term risk-free rate for certain types of products. And I'd like to turn to Axel and Tom to really talk about the UK and the US paths, because I think that's really constructive in how we're approaching things in Canada. They've taken divergent routes, and I think that's interesting context for us. So maybe I could start with Axel.
Okay, thank you, Sonia. Basically the UK approached let's call it the whole issue with regards to term rates, and therefore how to transition away from LIBOR, which was a term rate, and whether you needed a term rate in the middle or not. In a way, in two stages. I think in the beginning, there certainly was from the industry a feeling that there was a need or necessity for a term rate. I think the official sector had always been more, let's call it, reluctant to believe it, for the very simple reason that, of course, basically, the overnight rate is ultimately the one rate that is totally indestructible when it comes to basically setting where it is set, and therefore totally free from manipulation. In the first stage, therefore, in the UK, they set up a working group under the RFR working group in London at the time in order to explore two things. One was basically for possible ways of how to construct the term rate. And the second part was at least the first go at what types of products should not be allowed to use a term rate and what types of products could be allowed to use a term rate. I think as a group, I think we came with a conclusion that must have been the end of 2019, where we effectively said, and we also would recommend it to use, let's call it the SONIA overnight index swap market as, let's call it as the means to probably create it, because that way still allows you to create what I call a time slice across the different maturity spectra rather than something that can be influenced by, let's call it, bunching of trades depending on the times of day, when also interest rate environments can change if you have had economic numbers or whatever. So that was one part. And as well as the first indication, of course, that by definition, all derivatives should use compounding in arrears and should not reference, let's say, term rates. They were really designed originally for cash products. I think the official sector, when they looked at it, they were, particularly in terms of the product definitions, they wanted to have a deeper dive in order to try to understand really where was it truly necessary to use a term rate and where actually does compounding in arrears work and where can it work. And that group, I think, took another, let's call it 6 months in order to come to the conclusion that effectively it's only retail product and emerging market product that really should be open to the use of the term rate, and the balance was really doable by compounding in arrears. This was then further strengthened by, let's call it employing, that's what they call, I think it's the Financial Market Standards Board, which is a UK, in the UK at least, is therefore is a conglomeration of, let's say, the asset management industry, the sell side, the buy side, corporates, issuers, you name it, all potential wholesale financial market participants. They wrote effectively a code of conduct with regards to what types of product could be constructed or could be seen as using term rates and what shouldn't be seen as using term rates. Where again, the answer was very clear. Compounding in arrears works perfectly well for 90% of, let's call it, the volume of transactions. And for the balance, you could look at simpler things, which was in the UK, then let's call it using the base rate plus the spread, in order to, again, to try to allow as big a utilization as well. The other problem, in a way, that the UK has vis-a-vis the US, and I sort of think that this is almost like deliberate. In the UK, they invited multiple vendors to try to come up with the creation of a term benchmark, which then got you to a point that at the moment, there's still 2 benchmark providers for term SONIA rates in the UK, which then also form a transition perspective. If people want to transition from LIBOR to a term rate, it becomes much harder to try to define it, because what happens if your client thinks that he gets transferred to the wrong rate, i.e. the one that is too high? So these things have certainly led that term rates are let's call it the exception, as well that they actually are using, let's say, the SONIA underlying overnight index swap market as its base rather than the futures market, which is also very different from the US. So Tom, maybe.
Yeah, no, thank you. And I think this topic and many other topics, I think, really, provide a really good example of how each of the national working groups, has been borrowing best practices from each other and sort of seeing the evolution of this work. We may arrive at different answers because certainly across currencies and products and market participants, we may see that there are unique characteristics in certain markets that would lead to a different answer. But in every case, we've really all asked ourselves the same questions, and we've leveraged what's worked in other places. So, in the U.S., I think the same questions are: can you construct a term rate? Is it doable to even have a term rate that meets the IOSCO principles? That's transaction based in nature, and can it be done? I think that was the first step. Then, really, does it meet those benchmark principles? What is the scope of use? To Axel's point, right? You want to make sure that you don't actually recreate the problem we've been trying to solve for all these years, which is that self-referencing or inverted pyramid that Carl discusses. Too few transactions supporting too many contracts. Is it fit for purpose for the things that you've put in place? How would it be possible to limit the use to the places where it's absolutely needed? And to really ask the hard questions, which is, as it comes down to this, is this more a want or a need? Is this something that's a nice to have because it's just really convenient and it fits into people's existing systems and avoids, what we think is the better work of actually figuring out how to use compounding, which from the ARC's perspective, even after we endorsed the CME's term rate, we're very clear that we think in most cases and nearly all cases, overnight compounding is the best answer. So as we start working through the scope of use, what we learned is that to the extent that we could see enough volume to support that rate, that we could take it to a point where we knew there were very particular specific parts of the cash markets in the U.S. that really were not going to be able to transition without that. It became imperative that we actually directed it and focused the term rate in those areas. So our kind of overarching principles in this and our scope of use has been, use overnights where you can, where the markets have already transitioned, derivatives, floating rate notes. Let's look at other places like trade finance, where it's near impossible to operate without a forward-looking term rate. And then think about the things in the middle, like securitizations, where it may or may not be appropriate, depending on the market participant, depending on the product. So all those questions, I think, have been asked in each one of these national working groups. And I think the similar discussions obviously are happening at CAR. So I think when we think about international coordination, we think about term rates, we ask ourselves the same questions. We may arrive at different answers, but I think we're all sort of holding true to those core principles, which is avoid that self-referencing problem that we had before, while giving the market tools enough to effectively have that transition take place.
Axel and Tom, thank you very much for that. And we appreciate all the work that's been done in advance to support what we're doing in Canada at this stage. Carl, given what we've just heard, can you comment on how CAR is looking at the need for a term CORA in Canada? And I see in the chat, there's a question from Frank Zal. Similar to the development in the US, do you foresee a credit-sensitive alternative to Cedor? Maybe you could answer that question with your comments as well. Thanks, Carl.
Absolutely. So happy to put a Canadian context on it. And ultimately, everybody on the call should know that the national working groups work very well together in sharing best practices. And that's something we'll talk about a little bit later in this panel discussion, but this is one of them. This is an area of keen interest and some complexity. And while we are still in the early stages of our planning the transition, it is certainly already embedded in our thoughts. And maybe I'll just touch on trying to be very direct in terms of the principles that we're adopting within CAR. So our transition plan was very discreet in terms of the June 2023 date, where there would be no new Cedor after that date for derivatives or securities. And in that respect, it is the expectation of CAR that all of those products and asset classes would be using overnight CORA and would not be using term CORA. The extension to the June 24 was partially allowed for the potential development of a term rate if it is needed. And Tom and Axel both talked about the want and need. Different experiences in the UK than in the US, and we will be looking and adapting our plans and our processes to the needs of Canada. But we've built it into our plan. And in terms of the question around a credit-sensitive rate, it was something that we thought long and hard about, and whether we could create an IOSCO-compliant one in Canada, and whether there would be sufficient liquidity if we did. And it was decided that we wanted to ensure that we had the most robust system that would be resilient to the future and allow market participants the highest amount of liquidity. And that is where risk-free rates are the basis, whether it's overnight or term. So certainly the current methodology and approach of CAR does not embrace a credit-sensitive alternative and is focused on risk-free rates.
Thank you, Carl. And maybe I'll just wrap this portion of the discussion with a quick question for Toni on your perspective on having a term CORA in Canada, and whether the bank will be the administrator.
As Carl mentioned, it's very much it's under CAR's work plan to see if the industry, whether or not the industry needs a term CORA. Just in that their deliberation, it will be pretty clear that it would have to be IOSCO compliant and probably at least regulated by the CSA in Canada, given it's likely to be an important benchmark or critical benchmark. In terms of the bank being an administrator, the bank has no plans in terms of being an administrator of a term rate, benchmark rate, and we fully expect that to the extent that the industry decides there is a need for a term CORA, that the industry would go out and do some sort of RFP looking for the most appropriate administrator if it does come to that conclusion.
Terrific. Thank you, Toni. So let me now turn to BAs. As CAR's recommendations with respect to the publication of Cedor don't really cover this yet. The white paper clearly shows that Cedor and BA-based lending are closely interlinked. So, Barbara, maybe I could turn to you to comment on your thoughts on the BA-based lending and the issuance of BAs and the path forward there. Barbara, you're still on mute. We all do it still. It's amazing.
Someone had to do it. First, let me say that BA lending doesn't necessarily have to go away just because Cedor goes away. But my guess is that is what will happen over time, and I'll sort of walk through why. As Toni mentioned, today we have loan facilities that are BA-based and result in the issuance of BAs. And we have facilities that are price-based on Cedor, but don't result in the issuance of a BA. And the trend over the last 5 or 6 years have been away from facilities that result in the issuance of BAs. At the same time, and as Toni mentioned as well, of the BAs that are issued in the market, more and more are being held on the bank's balance sheets rather than actually being issued into the market. So they're being created, but they're not being issued into the market and rather are just being held by the banks. And the reality is that BA funding is not used by banks to fund BA facilities. And in fact, while BAs are generally 30-day instruments, banks don't have a large need for 30-day funding. Sophisticated banks match the term of their funding with that of their assets, and BA loan facilities generally have terms of 3 years or more, and the banks don't have a lot of assets with a 30-day term. The banks do require short-term funding, but those funding needs are better met with other money market instruments like BDMs, that can be issued for terms of between 90 days and a year, which is more consistent with the bank's short-term funding needs. So banks won't be encouraging clients to continue borrowing by way of BA facilities, is what I would expect, since it just results in the creation of a funding instrument that banks don't need. So will banks continue to make BA facilities available? I think it will depend on client demand. So, will clients still want BA facilities post Cedor? I think the likelihood is that the demand from clients will reduce over time. Many clients want to enter into interest rate swaps, and they'll likely prefer a reference rate like Cora that doesn't leave them with the basis risk if they enter into an interest rate derivative. And as the volumes and liquidity in the BA markets dwindle, it's likely to be less liquid and therefore less attractive to borrowers. Having said that, the banks do understand the importance of BAs continuing to be issued into the market and actively traded until Cedor is officially retired. And so this is like a post-June 2024 type scenario that we contemplate when BA facilities may eventually become a thing of the past.
Barbara, thank you very much for that. I know you've highlighted this as a bit of a longer term issue, but I would like, Toni, maybe for you to comment. BAs represent 20% of the Canadian money market, and the bank has viewed BAs as core funding market. So although this is, pushed out longer term, does this create any concerns for on the bank's part if they do disappear?
Well, I think it would be an industry concern. I think right now in the current state of the world, it represents 20% of money markets. But I mean, the industry and financial system have an uncanny ability to evolve and adapt. So I think what we've undertaken to do, or CFIF has undertaken to do, the committee I co-chair with Jim Berg from RBC, is that it's really important to understand the dynamics, the need, the uses, and the potential alternatives to BA for money market investors. So we've undertaken to kickstart this kind of the discussion process by organizing targeted workshops that are set to start in the next month or so to better get a handle, at least on the potential need or not, of what would happen to the BA market as we go forward. And if after the end of those targeted workshops, we have a better sense that there's a constraint to adaptability, or there's a definite need, or if there's a better understanding that there are potential alternatives and the market can evolve away from BAs, we'll have that better sense, and we'll think of the next steps after that.
Terrific. Thank you, Toni. I want to now move to transition. Shockingly, our time is flying by here. And so, again, I want to come back to learning from the experiences of other markets. CAR's white paper specifically highlighted that one of the reasons that the CAR's transition timeline is relatively shorter than that of LIBOR is because Canada can learn from other jurisdictions' experiences. So, Tom and Axel, maybe I could come back to the two of you again to talk about best practices from the National Working Group's experience that you think are key for CAR to consider. And this time, maybe I'll start with you, Tom.
Thank you very much. Yeah, I think what we've all done is, as you look through the path of this, I think each of the national working groups across all these currencies really were unraveling the same problem, had very different paths, but also have similar goals. So sort of at the start of the race and the end of the race, we know where we want to be. We just, have taken some divergent paths, but in each and every case, every one of these groups, specific, and from the arts perspective, I can tell you, we've lifted a lot of things from what happened in the UK. We've taken things along the way, even though the timelines may be a little bit different. We've all, again, had these similar experiences, right? So what we've learned is really to begin is that we all know that we're dealing with, a lot of inertia to the status quo, and addressing that quickly was sort of one of the things to get out there. And that comes with a deadline, right? So if we think about the period from 2014 to Andrew Bailey's speech in 2017, progress was slow. because, the industry will respond to a deadline. And so once those deadlines were put out there, we saw a big pickup across all the currencies. And I think, as we looked at all this, we found that there's no such thing as over communication. Communication around this, getting to the parts of the market who may be less familiar with this, ensuring that all market participant groups are heard from. If we look back, to the point, if we missed a particular part of the market or a particular group, it's very difficult to get them back on side. So what we saw is that when we reformed the ARC after we had chosen SOFR and expanded it, we wanted to ensure that we had literally all precincts heard from, that we had regional banks, buy side, sell side, to ensure that we could build that consensus, because in the end, we do ask people to move along. The public-private partnership has been critical. And to the extent that there's no daylight between that, and those are moving forward together, responsibility of the industry, the responsibility to and from the official sector, anytime there's daylight, it fills with uncertainty. Uncertainty creates delays. So what we've learned all the way through this is that seeing all these principles, taking and borrowing those best practices from each other and seeing that success, I think, has benefited all of us. So what we learned along the way was there are several key principles we should all abide by, which is, get those deadlines out, communicate effectively, engage with the markets, ensure that there's consistency between the public and private sides of those partnerships, and communicate, share ideas, and put deadlines out there. One of the things that really helped us was these initiatives that came out of the CFTC's Market Risk Advisory Committee, these SOFR First initiatives. Well, SOFR First was, moving the interdealer markets from LIBOR to SOFR was 100% borrowed from SONIA First, which was done in the UK. So all of us are looking at what worked. All of us are looking what we might have done differently, but in each and every case, I think this international coordination, again, we know where we're starting, we know where we want to finish, and we have some divergent paths along the way. But every time someone turns over, when we see these other currencies actually sunsetting, I think we all learn, what we should all be doing. And obviously, we're in this very unique sort of uncharted territory in the U.S. of LIBOR continuing to be published, yet no new LIBOR supervisory guidance. So we're learning a lot in the first few weeks of that process as well.
Yeah, in a way, let's say the London Working Group, they had, let's call it the look back meeting last week, where we went through, what went well and what might have gone better. And I think it's very important, actually, what actually went very well. I think Tom is very right. One is communication, milestones, very important, the clear communication of those milestones, as well as basically having as wide a participation in the working groups as possible. And if there are specialized topics, create a sub-working group in order to ensure that every single element can be looked at in detail. Because unfortunately, in all of these things, the devil is in the detail, and that's where the problems will actually come to the fore. It's when you get the deep specialists involved to basically get them to talk about what is the issue, and therefore what is it that potentially can be done to try to solve it. The other thing, therefore, Tom mentioned it, for us, and I can sort of see it, the first initiatives, starting with SONIA first, then cross-currency first, then we had, the non-linear first, and the futures first, i.e. forcing the industry to actually put the risk-free reference rate as the preferred, if not the only actively quoted, let's say, instrument in the interdealer market was incredibly important to get the liquidity going, because clients, by definition, will always have two things. A, they're slower, but B, they always ask the question, I want to be in the most liquid place. Therefore, there we the last ones, and also the last ones and the least easy ones to basically get into the tent. And at the same time, it's very important, in order to get derivatives there, of course, be in line with the CCPs, work very closely with them. And what I think worked extremely well in the UK was, let's call it the CCP changeover process, a couple of weeks before the final transition, where over the weekend, I think in total, they must have transitioned 500,000 worth of transactions in a single weekend from, let's say, LIBOR reference rates to the fallback rates. And again, it worked very well as a process. And the other thing that for me, certainly I think was actually important, is you need to try to get your conventions of your products sorted very early. And the reason you need to do it early, because you need to get your IT providers actually into the same tent, that they can actually do their developments well before deadlines about new or no longer using a certain products are being hit. Because otherwise you're going to get to the point in time that product design gets driven by what is bookable rather than what is, let's say, desirable. I think that for me is a very important point. I'll sort of leave it at that.
Thank you, Tom and Axel. Carl, I would say that there's some good lessons learned and insights from what we're hearing from Tom and Axel. So can you comment on what of these practices that they've talked about you think can be incorporated into the Canadian transition plan, and what will that plan look like? And I'm going to throw another of our questions for you, since you're such a good multitasker. You can take this one as well. The question is, CAR is heavily dominated by Canadian firms. In order to increase the chances of having a successful transition away from Cedor, I would suggest that other key participants in the market, like major financial technology firms, should be invited to participate. Is there any plans to expand participation? So I'll throw that in with you, Carl. Thank you.
Great, happy to cover that off. And if there's one thing that has rung loud and clear, it is the best practices that have come out of the UK and US national working groups. And both Tom and Axel described them with clarity. It's communication, it's milestones, and it's conventions and fallbacks. So those are things that are absolutely core to our plan and strategy. And in fact, we've actually embraced those prior to our transition in preparation, not actually knowing what our ultimate recommendation was going to be, but as we had embarked on the enhancement of CORA, and we'd worked with ISDA around fallback language. We'd already established conventions for CORA FRNs, fallbacks, both across cash products as well as derivatives. So I really feel like that process is well underway, and we haven't even started the transition. So as we've embarked on the transition and pivoted away from our very definitive focus on Cedor and what our recommendation is related to Cedor, we now pivot to this two-stage transition. And to do so, we've created 7 different subgroups. And similar to what Tom and Axel were saying, within these subgroups, we do have to drill down into subject matter experts, which we are calling work streams within that. And to answer the question related to international, whether it's infrastructure participants or other market participants, this is where we would welcome their involvement. And why don't I just touch on the 7 different subgroups to give you a flavor. So they include a derivative subgroup, a loans subgroup, securities, term CORA, and then there's operations and infrastructure, outreach and communications, and the last one, which is our accounting, tax, and regulatory. So these are the this will be where the body of work is really done for the transition to deliver on first our first stage, which is going to be moving most of the exposure over to overnight CORA, and then the second stage, which allows us another year to deal with some of the outstanding legacy, but also allow for loans. And if loans need a forward-looking term risk-free rate, then we will look to put that in, and that we have a specific subgroup that is focused on that. So this initiative is just getting up and running. Harry and I are working with banks and market participants, both domestic and international, to staff these. If there are people on this call that would like to be involved, please do so. So that's the overview of the plan to date, Sonia.
Terrific. Thank you, Carl. I'd like to now turn back to Barbara, just to get a sense as to what these changes are expecting to mean to TD and to the Canadian banking system in general? How are you planning to go about the transition? What concerns you most about it? I mean, these are big changes and lots of work and preparation needs to go into it. So maybe you could share with our participants some insights on that, Barbara.
So you're right, certainly, that there's a lot of work that needs to be done. I will say, I think, it's been a very good decision to sequence this effort behind similar efforts in the US and the UK, because the lessons learned that were talked about, are very valuable to us in terms of making the transition here smoother. And, I think that the banks generally have, sort of armies of people who have just worked through the US dollar LIBOR transition. And those same teams will really, transition right to looking at Cedor next. But there is a very large amount of work to be done. I mean, things like, changing the products that we are offering into the market, updating our risk and balance sheet management methodologies and processes, and working with customers and clients to modify a large number of outstanding agreements. My advice to people on the phone or elsewhere who weren't impacted by the LIBOR transition is to not underestimate the amount of work. But rest assured that the banks understand that there's a large role for us to play in helping our clients with the transition. And so, we do have that experience and we stand ready to provide that assistance. You just wanted to make me look less bad. Thank you.
Yeah, that's my job as the moderator. We'll stick with that story, Barbara. I know you are involved in this as a member of one of the largest banks in Canada. For some of the smaller banks, any concerns particularly that you think there in terms of their ability to manage through this transition?
I don't think the concerns are different, and I have the same advice. Like, it is a lot of work, and it requires a budget, and you can't really start too early. It's at TD, we found it very helpful to have an enterprise-led team looking at this. So rather than leave it to be sort of decentralized, I think having that central group that could help keep the businesses coordinated in terms of their approach to this and share intelligence was very helpful. It is there's a lot of risk associated with this. So certainly at our bank, and I'm sure at the other larger banks, there was a lot of very senior communication so that we could monitor the risk, make sure we were managing the risk and had the right resources. And we found all of that very beneficial.
That's good advice. Thank you, Barbara. So Axel, as an active derivative user, maybe you could talk about what this transition means for you and, advice or pointers that you could provide to market participants as they think about their own transitions.
Yeah. One, it's almost like probably for most people, you need to almost like redesign your entire process flow. Therefore, you need to look at, I think, when we set up our LIBOR transition working group, let's so to speak, at EBRD, I think we had 9 different underlying work streams. And one of the most important things is getting to the point, is getting clarity on what it is you want to do in terms of your own, let's say, product design and product provision. For us, the longest time we probably spent on 2 things. One is internal transfer pricing processes that probably need to completely be redefined or redesigned. And the second one is our loan product. For that matter, I think, in loan products, I think it's actually quite good to think through what does it mean if you want to work or need to work with, let's say, a compounding in arrears type of product, and what can you do in order to actually facilitate it, to make it easy from a client perspective as well. And that's why one of the things that we certainly are advocating are using is what's called either the SOFR index or the SONIA index, which can actually be utilized to get exact calculations of what accrued interest is, as well as it's a simple calculation that I can do at the back of an envelope without having to create a spreadsheet of 90 compounded rates with different rounding conventions, et cetera, et cetera, et cetera. So that, I think, has worked very well for us. And the other thing is just you need to be very aware, and certainly as a bank, of course, we're a floating rate balance sheet, and we therefore looked at the pricing of, let's call it the basis between here for us was LIBOR and SOFR and SONIA, to see whether we want to transition the asset side first or the liability side first. Therefore, depending as to how the pricing is in the market versus your expected pricing of the, let's call it the terminal rates, I think you need to think about, therefore, what is in your best interest to do it. And at the same time, you need to be very aware, certainly as a bank, that you are open and transparent to your clients, that you also advise them what is in their best interest, that you don't look at it purely from your own perspective. Because they're the ones that are at let's call it an information disadvantage to you. And therefore, I think, again, in the UK, the FCA was very clear, and they even made it a very clear conduct note that they sent out, that as a bank, you are required to make everything clear, clean, and transparent to your clients so that they know what is the right decision for them to make rather than what is in the best interest of the banks. I'll sort of leave it at that because you can go on for hours about this. It's a complicated process, I can guarantee you that.
Well, thank you. So just building on that, a bit of a follow-up in terms of addressing liquidity. And maybe I'll come back to you, but first to Barbara as well. What are your main concerns with respect to market liquidity as you consider this transition from Cedor to Cora? Barbara, maybe you can kick that off. Thank you.
Sure. Yes, and it is a bit of a sort of a tricky chicken and the egg type situation, especially in a small market like Canada. So we need transaction volumes to create liquidity, but liquidity, transaction volumes, are unlikely to come forward when there is limited liquidity. And it's also critical that the cash and derivatives market evolve together for proper functioning of the market. So I think, we're fortunate to have the benefit of lessons learned in other markets. And so, Tom walked through a number, I think it was Tom, walked through a number of the things that were done in the UK and also in the US, things like publishing best practices, transaction milestones, the sort of SOFR first type initiatives. These were all very helpful in developing volumes in the risk-free rate. And I would expect that we're going to need similar things here in order for liquidity to develop. I don't think we can just let the market evolve that way because of that chicken and egg type dilemma that it creates. I also expect that large market participants will take a leadership role in moving the market forward. And I think, that happened in other markets and is very likely to happen here as well.
So, Sonia, I might just jump in here if I can and follow on from Barbara. Just in terms of the plan around liquidity, CAR is acutely aware of the importance of getting the transition from a Cedor-based underlying to a Cora-based underlying right. And part of that will be, the communication and creating transparency around what the plan is. So we've initially started that out with being clear about this June 30th, 2023 date. And it would be my anticipation that there will be a concentrated window or some kind of compressed time frame, because Canada and the Canadian market is different than the US market, it's different than the UK market. And we do not want a dysfunctional Cedor and a Cora market in some kind of transition that is not clear. And we know that market participants, whether they're hedgers or whether they need to address issues related to their own fiduciary duties, they need to transact in liquid underlyings. So that we will plan and adapt, and and I'll give you the example where whether it's securities or the derivative subgroup, in derivatives, and this is similar to what Axel was saying, we're going to have focus on cleared, non-cleared OTC bilateral, non-linear, listed futures, repo, structured products. That's just within the derivative subgroup. And so taking all of these in, getting the feedback, making the plan discrete, communicating it well, and hopefully that will learn from the lessons learned from both the UK and the US, and we'll be able to deliver on that objective. But just wanted to make sure that we're acutely aware. Like Barbara was saying, the banks and other important leaders in the market from an issuance standpoint, like CMHC, who issues benchmark size CMB floating rate notes, they will be important leaders. They've already said into the market that they will start using CORA as a reference rate. More banks are going to start using that, and so you're going to see an evolution of liquidity in the securities market. But we want to be clear about what the expectation is in the underlying rate market as far as liquidity and timing.
Terrific. Thank you, Carl. Axel, anything you want to add to this, to what Barbara and Carl have already said?
Very quickly, basically, I know where the market will go to. Therefore, to be quite honest, as a balance sheet user and a hedger, I'll just look at, basically, I know where the liquidity will ultimately be. Therefore, I'm quite happy to live through something that's a little bit less liquid in the meantime. We know we're going to get there. Therefore, I'm quite happy to use it in whatever shape or form.
Terrific. Thank you, Axel. And we're sort of down to the wire here, but I would like to go to Tom, just because we know market experience is really important here. Is there anything that you can share with us from the U.S. experience with respect to the transition from U.S. LIBOR to SOFR liquidity?
Yeah, I think everything gets back to that same theory about milestones, and we find that liquidity brings more liquidity. So to the extent that we, going way back to even the clearinghouses changing the discounting methodology, that creates more demand. So, I think when we look at where we are now in the U.S., a lot of focus on the exchange traded derivatives market, Eurodollars, which, largely, the liquidity providers are outside the banks, the supervised banks. So how does that get moving? And I think what we're seeing is more and more as we put dates out there. SOFR first for derivatives, linear, non-linear, cross currency. We found is that when we did the cross currency SOFR first for that leg for several currencies, we were requested by the market to expand that to all currencies. So as the success does breed success, and to the extent that we've seen things tip and the market moves, to Axel's point, as when it became just as easy to do a SOFR trade as a LIBOR trade, even those who were willing to pay a little bit more to use SOFR, when that became even, we saw a big tipping point. So as all these supervisory guidance take place as we entered this year, more and more demand. So we're looking now really at the options market. SOFR options. If SOFR options became more liquid, we know that all the hedging around that will become more liquid. So our experience is get dates out there. As things get moving, that liquidity will draw much more liquidity.
Thank you, Tom. And I was going to end there, but I do have to ask. There's been a flood of questions come in that are all fairly similar, which I want to turn to Carl on, because obviously all of you have made this sound so exciting that there's a lot of demand to participate. So there are a number of questions that have come in about including representation from smaller players in the discussion on reform and transition, and it's come in numerous forms from different groups. But maybe, Carl, you could just address that in aggregate.
Happy to, and thanks for that, because this is part of our outreach, and ultimately we want to get to as many market participants and those that want to have a voice as possible. So just in terms of the construction of CAR, it was different than the ARC and the Sterling Working Group from inception, i.e. we had it balanced between sell side or bank and dealer, as well as non-bank and dealer. So that included government, that included pension plans, asset managers, and corporates. We just recently, as we've embarked on the transition, expanded that to include smaller financials, so credit unions right across the country, as well as increase the participation of corporates. So now we have 3 corporates represented. And can I just say that each of the large non-banks are also very large issuers in the marketplace and borrowers too. So we believe that we're trying to balance at the level of CAR the representation across the different constituencies. However, there will be a lot of involvement with corporates, with smaller asset managers and financial institutions in the subgroups, and even more so in the work streams. So we need people that are committed and passionate about helping us get to the right destination. And I will direct everybody also a little plug for CAR on the Bank of Canada's website, so that if there are things that you want to know or to communicate to CAR, including Harry, myself, and Tony, please go to the CAR's website. And if you wish to join this this movement to CORA and term CORA possibly, then please let us know, because we're certainly looking for any and all participants.
Carl, thank you. With that, I know there are more questions, but we are going to call it a wrap. For anyone who did not feel that their question was sufficiently addressed in the comments from the panelists, please also follow that same piece of advice from Carl and go to the CAR webpage, send an email. You'll get a response back to anything that you might like. I would like to very much thank Scott and Toni and all of the panelists and Harry. A lot of work has gone into getting us here, and a lot of time on all of their parts to keep the industry engaged in this discussion. So thank you to everyone. Thank you for inviting me to be the moderator. Although I must say, every time somebody said the word Sonia, I thought somebody was trying to ask me a question. It drives me batty. But with that, I think I'm turning this back to Anne for the final word.
Thank you, Sonia. I echo your comment about Sonia, but I guess it's a interesting coincidence. Thank you also to the Bank of Canada, all of our presenters, and thank you to everyone for joining us today. You will receive a follow-up email with a link to view the recording of today's event within the next business day. If you need CLE, CPE, or CPOD credit, don't forget to complete the poll question found under the Survey tab. ISDA will be holding more virtual conferences this month on a number of topics, including understanding the ISDA Master Agreements and negotiating the schedule to the ISDA Master Agreement, international and EU banking, as well as Phase 6 of the initial margin requirements. Please visit www.isda.org/events for more information about these and other events, as well as registration. Additionally, ISDA's 36th annual general meeting will be held this year in Madrid on May 10th through 12th. This year, it will be open to members and non-members. Early registration pricing is available. Visit ISDA's events page to view the agenda and register. If you have any other questions, please contact the ISDA Conference Department at conferences@isda.org. On behalf of ISDA and our presenters, thank you again to the Bank of Canada, and thanks to all of you for joining us.